$12.
That's the gap right now. Today, March 7th, 2026, between what silver costs on a screen in New York and what physical buyers in Shanghai are actually paying for the exact same metal, $12 per ounce. And if you think that's just some accounting quirk or a currency conversion rounding error, I need you to stay with me for the next 20 minutes, because that gap is the most important signal in the entire precious metals market right now. And here's what makes this even more striking. Just as that physical market screams that silver is worth more than what paper traders are paying, the CME, the largest derivatives exchange on Earth, just cut silver's margin requirement from 18% down to 14%. Effective yesterday, March 6, 2026. A 22% reduction in the cost of holding a paper silver position. Now, why would the world's biggest exchange slash the cost of betting on silver right at the exact moment physical silver is commanding a premium in Asia? That question should keep you up at night. Because when you understand why those two things are happening simultaneously, you'll see something very few people are talking about. And by the end of this video, you will understand it completely. Let me give you the lay of the land first, because context matters. Silver hit a historic all-time peak of $121.64 per ounce back in late January of this year. That wasn't a blip. Silver started 2025 near $30 an ounce and ran up almost 300% in about 14 months. That is one of the most extraordinary commodity moves in modern history. Then, on January 29, 2026, the CME did what it's done before in moments exactly like this. It raised margin requirements, from 15% to 18% on COMEX 5,000-ounce silver futures, and the cascade that followed was violent. Silver fell from $121 to the mid-70s in a matter of days, a 33% single-day collapse from the intraday peak. Traders who were leveraged got margin calls. Margin calls force selling. Forced selling creates more margin calls. The feedback loop was textbook. By March 3rd, silver was sitting at $82.46. March 5th, $82.78. And as of this morning, March 7th, we're hovering around $83 to $84 on the COMEX futures screen. Meanwhile, in Shanghai, where buyers actually need physical metal for solar panels, electronics, EV batteries, and solid-state batteries, the price is sitting around $95 to $96 per ounce. That's not a rounding difference. That's a structural fracture. Now here's a quick message for those of you who aren't subscribed yet. My analytics show roughly 3 out of 4 people watching this right now haven't hit the subscribe button. If this kind of deep dive analysis is cutting through the noise for you, subscribe right now. That's how I know who the committed community is. It helps me, it helps the algorithm get this information in front of people who actually need it. Hit subscribe, it takes 2 seconds, and I'll keep digging for you. Back to the fracture. Because this isn't the first time we've seen this, the gap between what paper says and what physical buyers pay doesn't just happen in a vacuum. And every single time in history that this gap has persisted, it has resolved. Not by physical prices coming down, but by paper prices eventually catching up to physical reality. Let me walk you through why. To understand what's happening right now, you need to understand the architecture of the silver market, because most people watching this video have no idea how it actually works. When you see silver at $83 on a financial news ticker, that number is generated by the COMEX futures market in New York. It is a derivatives market. The vast majority of contracts traded there are never, ever backed by real metal. According to data tracked by analysts monitoring COMEX open interest, there are currently paper claims on silver that outnumber the physical metal actually registered for delivery by roughly 300 to 1. You read that right. For every 1 real ounce of deliverable silver in a COMEX vault, there are approximately 300 pieces of paper claiming it. That's not a conspiracy theory. That is how futures markets are designed. They're designed for hedging and price discovery, not for bulk physical delivery. Most of the time, that system works perfectly fine because most traders never actually want the metal. They just want the financial exposure. But here's what breaks that system. When institutional buyers, industrial users, central banks, and sovereign wealth funds start demanding actual delivery of actual silver, the math falls apart. And that is exactly what has been happening since the second half of 2025. Let me show you the numbers, because this is where it gets genuinely alarming. According to COMEX depository data published by CME Group, registered silver inventory, that's the metal actually available for delivery right now, has fallen from roughly 240 million ounces back in April 2020 to just 86.13 million ounces as of late February 2026. That is a 64.1% decline in deliverable silver over 6 years. Gone. And the pace is accelerating. In a single week in early January 2026, 33.45 million ounces were physically withdrawn from COMEX in 1 week. That represented 26% of the entire registered inventory at the time. To put that in perspective, in January 2025, COMEX deliveries for the full month were typically 1 to 5 million ounces. In January 2026, estimates put the full month at 33 to 40 million ounces. That is a 7 to 10 times increase in a single year. February 2026 was even more telling. Total contracts delivered in February came to 5,036 contracts, representing 25.18 million ounces. According to research published on Substack by analyst Jin Lo, that is 5 to 8 times historical norms for a February delivery month. This isn't profit-taking. These are industrial users and institutional investors saying, "I don't trust the paper promise anymore. Give me the metal." Now, stick with me here because I want to show you what this drain looks like in the context of open interest, because this is the smoking gun. As of late February 2026, COMEX registered inventory stood at roughly 86 million ounces. Against that, open interest in the March 2026 silver contract represented approximately 52.63 million ounces in delivery demand from just the March contracts. That means the outstanding delivery demand from March contracts alone amounts to about 61% of everything left in the vault. And that's before you factor in the fact that some of what's listed as registered is encumbered, pre-allocated, or held by parties who have zero intention of delivering it. The free float of truly available, unencumbered silver is significantly smaller than even the 86 million ounce headline suggests. Here's where it gets worse, and I told you it would get worse. On February 11th, 2026, a single-day negative adjustment in the registered category totaled 3,256,882 ounces in 1 day. The total registered balance fell below the 100 million ounce threshold on that date for the first time in this cycle. And on the same day, more than 4.7 million ounces left the eligible category as well. Total withdrawals in one 24-hour period, 4.7 million ounces net. The metal is leaving. It is not coming back. And this brings us directly to Shanghai. The Shanghai Gold Exchange and the Shanghai Futures Exchange operate entirely differently from COMEX. In Shanghai, physical delivery is the norm, not the exception. When you trade silver in Shanghai, you are trading real metal, and a real buyer takes it out of the warehouse to put into a solar panel factory, or an EV battery plant, or a medical device manufacturer. So the price Shanghai sets is the price at which physical silver actually clears hands. And right now, that price is about $12 higher per ounce than what the New York paper market says. Now, in a normal market, this would be closed immediately by arbitrage. You'd buy on COMEX for $83, ship the metal to Shanghai, sell at $95, pocket the $12 minus shipping costs of maybe $1 to $2 per ounce, and do it again tomorrow. That's the textbook play. But here's why it's not happening at scale. When you actually try to pull physical silver out of COMEX to ship to Asia, you run straight into the inventory problem I just described. There isn't enough metal to move. Analysts at A Invest noted that COMEX inventory is down 26% since the start of 2026 from physical withdrawals alone. And it gets worse when you add China's side of the equation. China reclassified silver as a strategic material. As of January 1st, 2026, China introduced an export licensing system for silver that limits overseas sales to large, state-certified producers. The country that controls between 60 and 70% of global refined silver output essentially said, "Our silver stays here." According to research by Trading Key, China's domestic silver stocks hit near decade lows heading into 2026. And at the same time, industrial demand from solar panels, electric vehicles, and a new and rapidly growing category, solid-state batteries, is chewing through supply faster than mines can replace it. Let me put that in plain terms. The world's biggest silver consumer just restricted silver from leaving. The world's biggest silver warehouse is draining to 60-year lows, and the price the paper market shows doesn't reflect any of this yet. That's the gap. That $12 spread between New York and Shanghai isn't noise. It's the physical market trying to communicate something the paper market isn't ready to hear. Now let me bring in the historical pattern here because this is critical context. We've been in this exact setup before, 3 times in fact. The first time the paper market and physical reality diverged this dramatically in silver was 1980. The Hunt brothers had been accumulating physical silver for years. By early 1980, silver was at $50 an ounce. At the time, the COMEX had roughly the same problem, paper claims vastly exceeding available physical metal. So what did the exchange do? They changed the rules. They called it Silver Rule 7. Effectively, they banned new long positions and forced everyone to liquidate. The price collapsed from $50 to $10 in a matter of weeks. The Hunts went bankrupt. The rule change worked. But here's the important detail. The physical shortage that drove the price was real. The intervention was regulatory. The price was eventually suppressed. But the underlying conditions, supply deficits, industrial demand, paper overhang, did not go away. They just went underground. The second time was 2011. Silver ran from $18 to $49.51, nearly $50, between August 2010 and April 2011. The driver was the same, paper-to-physical ratio stress, global quantitative easing by the Fed after the 2008 crisis, and institutional demand for real assets. Once again, the CME stepped in. They raised margin requirements 5 times in 9 days. 5 times. In 9 days. Each hike forced more liquidations. Silver fell from $49 to $33 in 3 weeks. The paper market was defended. And then, between 2011 and 2020, silver essentially flatlined for a decade while industrial demand kept building. The third time was the Reddit-driven silver squeeze of early 2021. Retail investors tried to break the paper market by demanding physical delivery. It caused a brief spike to around $30, but the volumes involved were too small to stress the actual system. The attempt failed. But what it revealed was the awareness, growing, spreading, deepening, that the paper silver price and the physical silver price are 2 different animals. Here's what's different this time. Each of those previous moments, the suppression mechanism worked because physical supply was ultimately sufficient to satisfy demand if you raise prices enough. Today, that's not true. Global silver supply has been running at a structural deficit for multiple years. The Silver Institute's data shows the silver market has been in supply deficit since 2021. Those deficits compound. They don't just disappear. And the demand side of the equation has fundamentally changed. Solar panel manufacturing alone consumes over 200 million ounces per year and is growing at 20% annually. AI data centers require silver-loaded components and are being built by the hundreds. The electrification of transportation doesn't just need lithium, it needs silver. Every solid-state battery being developed uses silver at a rate 30 to 50 times higher than traditional lithium-ion cells. This is not like 1980 where the squeeze was financial. It's not like 2011 where it was macro-driven speculation. This is structural. The world is building things that require silver at a pace that mining cannot match, while the exchange warehouses that underpin the paper market are running dry. And now the CME just cut margin requirements. Let me explain why that matters enormously right now. On February 6, 2026, CME raised silver margins from 15% to 18%. That was the 6th margin hike in this cycle. The rationale, per the exchange, was normal review of market volatility to ensure adequate collateral coverage. Translation: silver was at $120, things were getting chaotic, we need to cool this down. And it worked, mechanically. The price fell from $120 to the mid-70s. Speculative longs got liquidated. The froth came off. But here's what just happened. As of March 6, 2026, yesterday, the CME announced it is cutting silver margins from 18% back down to 14%. Gold margins were cut simultaneously from 9% to 7%. According to Reuters, which reported the announcement, the new requirements took effect after market close on March 6th. That is a 22% reduction in the cost of holding a leveraged long position in paper silver. Right now, today. Think about what that signal is. When the CME raises margins, it's a bear signal. It's saying, this market is too hot, we're putting the brakes on. When the CME cuts margins, it's the opposite. It's saying, we want more participants, more leverage, more trading activity. And they are doing this cut at a price of $83 to $84, nearly $40 below the all-time high from 6 weeks ago, while Shanghai is paying $12 more for the same physical ounce. Now here's where the two things collide. The paper market is being invited back to the table via cheaper margin requirements, which means the cost of opening a leveraged long position in COMEX silver just dropped significantly. More traders can hold bigger paper positions with less capital. That structurally increases buying pressure in the paper futures market. At the same time, the physical market in Shanghai is clearing $12 higher, signaling that the real-world demand for actual deliverable silver is not satisfied by the paper price. Those two forces are pointing in the same direction, higher, but they are not synchronized yet. The paper price is being given new fuel by the margin cut. The physical market is already priced higher by physical scarcity. When these two prices converge, it won't be the Shanghai price coming down to meet $83. History says it's the paper market that eventually reprices upward. And this is the exact dynamic that preceded every major silver repricing in history. The paper market trails the physical market. The gap between them builds tension. The tension releases, violently usually, and the price resets higher. Let me talk about the institutional positioning piece because you need to understand who's actually doing the buying here. It's not retail. JP Morgan, who has historically been one of the largest short sellers in COMEX silver, a position that was the subject of a federal criminal investigation and resulted in a $920 million settlement in 2020, has now shifted its posture significantly. January 7, 2026, COMEX delivery data showed that JP Morgan was responsible for delivering 99% of the 8.1 million ounces of silver issued in that single delivery session. The bank that was once the primary short seller in silver became the primary deliverer of physical silver. That is a structural role reversal. Barclays, in a note published in early February 2026, stated it expects rate cuts, fiscal expansion, quantitative easing, fiat debasement, and de-dollarization to keep investment demand firm for precious metals. Those are tailwinds, not headwinds. And while speculative positioning has actually been fairly light, managed money net long contracts fell from 54,415 contracts in February 2025 to just 12,121 contracts in February 2026, a 77.72% drop year over year. The physical delivery demand exploded simultaneously. This is the clearest possible signal that what's driving this market is not retail speculation or meme stock energy. It's institutional and industrial users who need the metal and are willing to pay up for it. So what does all of this mean for you practically? Let me give you the honest, clear picture, and as always, nothing I say here is financial advice. You make your own decisions. I'm here to give you the data and the framework. First, understand the two silver markets. There is the paper silver market, COMEX futures, silver ETFs like SLV, leveraged products, and there is the physical silver market. These two markets are now pricing at different levels with a meaningful and persistent spread. If you are in paper silver, the margin cut is bullish for your position in the short term because more leverage means more buying pressure. But if you are in paper silver and you ever need to convert that to actual metal, you should understand the cost of doing so today is higher than the screen price suggests. Second, the $83 to $84 price on COMEX right now is sitting far below both the January peak of $121 and the Shanghai physical price of $95 to $96. The gap between the current paper price and the recent all-time high is about $37. The gap between the paper price and the current physical price in the world's largest physical market is about $12. Both of those gaps are unusual by historical standards. Third, watch the COMEX inventory data every single day. The most important number to track is the registered inventory figure. That's the only silver that can legally satisfy delivery obligations. When registered inventory falls, delivery stress increases. The current level of roughly 86 million ounces against March open interest demand of over 52 million ounces is historically tight. If that number drops significantly in coming days, it is a major signal. Fourth, the CME margin cut is a double-edged sword. Yes, it invites more leveraged longs, but it also means that if prices fall sharply again, margin requirements will re-expand, and the liquidation feedback loop can restart. The margin cut makes the move up potentially faster, but it also makes the downside more acute if sentiment reverses. Fifth, the China silver export licensing regime is not going away. This is a structural change to global silver supply chains. The world's dominant silver refiner and consumer has decided silver is a strategic asset. That means the arbitrage mechanism that would normally close the Shanghai COMEX gap is permanently more difficult and expensive to execute than it was 12 months ago. Sixth, keep your eye on the gold-silver ratio. Right now, with gold near $5,000 per ounce and silver near $83, the ratio sits around 60 to 1. Historically, the ratio averages around 47 to 1 over the long run. During silver bull markets in 1980 and 2011, it compressed to 15 and 32 respectively. If this cycle follows the historical pattern even partially, the silver catch-up trade from current levels is substantial. And seventh, this one is practical, not theoretical. Physical silver premiums at dealers have been elevated for months. Even if the COMEX spot price says $83, the real-world cost of purchasing a 1-ounce silver coin from a dealer today includes a premium that reflects actual physical scarcity. That premium spread itself is data. It tells you what the free market thinks the real price of silver is when you strip away the paper futures layer. Let me bring this full circle, because I want to make sure you walk away with the clearest possible picture. We started with that $12 gap. $12 between what a New York screen says silver is worth and what a Shanghai buyer is paying for physical metal. That gap exists because the paper market is sitting at $83 to $84, while the physical market has already priced silver at $95 to $96 in the world's largest demand hub. That gap exists because 64.1% of COMEX's registered silver inventory has left the vault since 2020, and in January 2026 alone, withdrawals were 7 to 10 times the historical average. That gap exists because China, the country that controls most of the world's silver refining, has locked its metal behind an export licensing regime. That gap exists because the industrial demand side of the equation is no longer cyclical, it is structural and growing. Solar, EVs, AI infrastructure, and solid-state batteries are all competing for the same finite resource. And into that environment, yesterday the CME cut margins on silver from 18% to 14%, making it cheaper right now for leveraged traders to come back into the paper market. That sets up a collision. More paper demand, tighter physical supply, a price that is $12 lower in New York than in Shanghai. This is the setup. This is the configuration that has preceded every major silver repricing in the last 50 years. The mechanism is different each time. The math resolves the same way. People who held silver through the 1980 squeeze and got out early made extraordinary gains. People who held through the 2011 run made extraordinary gains. The ones who missed it weren't stupid. They just weren't watching these signals. They weren't tracking the COMEX inventory drain. They weren't comparing Shanghai physical prices to New York paper prices. They weren't watching what the CME does with margin requirements and thinking about what signal that sends. You're watching. That's why you're here. And now you understand exactly what's happening, why it's happening, and what to watch for next. I want to be absolutely clear. This is not a call to go lever up on silver futures. This video is not financial advice. Silver is volatile. The CME can raise margins again tomorrow. Prices can fall sharply before they go higher. There are scenarios where the physical paper gap closes because demand softens, not because the paper price rises. All of that is real risk. Do your own research, talk to a qualified financial professional, and never invest money you can't afford to lose in anything, let alone a commodity with silver's historical volatility. But here's my question for you, and drop this in the comments because I genuinely read every single one of them, and your answers shape what I cover next. Do you trust the paper price at $83 or the Shanghai physical price at $96? Because one of those markets is closer to the truth, and I think you already know which one. If this analysis hit differently for you today, if you feel like you just got a real education in how this market actually works, not how CNBC explains it, please share this with someone who needs to see it. Hit subscribe if you haven't. I don't run ads, I don't take sponsorships from precious metals dealers, and I don't push products. I just dig into the data and lay it out the way a friend would. The signals are all there. They were there in 1980. They were there in 2011. They're there now. The only question is whether you're paying attention.